name is David Schlossberg.
And I'm John Garvin. And we'd like to welcome you to the Investor Basics class at Ben Assured. In today's investing world, investment choices come in many flavors. So many choices, it's very easy to get overwhelmed. Primary categories most of us have heard about, are familiar with, are stocks and bonds. But there's much more than that. Before we dig in deeper, we'd like to break the choices into main categories, and then we'll break them down further and discuss various subcategories. A flowchart can be downloaded by clicking the link shown below.
Rather than invest in stocks or bonds directly, most investors choose to invest in either mutual funds or ETFs. Most of us would not know which individual stocks or bonds to invest in, nor will we have the ample funds to properly acquire enough investments to diversify our investments the way we should. That's why the mutual fund market exploded as 401ks gained popularity. Many smaller investors were provided the opportunity to pool their funds together and give it to a mutual fund manager to acquire the investments. With the pooled funds, managers had more buying power and can diversify the investment within the mutual fund's guidelines. These mutual funds must publish what investment categories, more commonly referred to as asset classes, that they're investing in. That assists investors in furthering their diversification by giving their money to multiple managers of different categories.
Some of the earliest mutual funds and most of today's ETFs are invested proportionally in everything within a subcategory, such as the S&P 500 index. The S&P 500 is comprised of the 500 largest companies in the United States. An S&P mutual fund or an ETF that strictly follows that index is referred to as a passive fund, as there is effectively little to no management required. They're just investing your funds into a set investment list. Passive investments typically have lower fees.
In contrast, an actively managed large cap mutual fund may very well invest in the same 500 companies, but may include some of them and exclude others. And the quantity of shares of each will likely vary from any discernible pattern. Active managers might invest strictly within their advertised subcategory, or they may invest a portion in other subclasses within published limits if their perspective allows them to. This investing in other categories outside of the main published category is referred to as style drift, as they may have drifted a portion of their investment monies away from the primary category. This drift is limited by the prospectus, which is a legal document that functions as a contract between the investor and the manager, and it spells out many items, including the manager's investment restrictions. Active managers hope to outperform or do better than the index of their category or subcategory. In other words, they seek greater returns than their passive counterparts. Because these managers need researchers and auditors to help in the investment selection process, the internal costs will be more than the passive investment alternatives.
So to summarize, passive funds will acquire underlying investments strictly to the components of the respective index. Actively managed funds, on the other hand, will attempt to outperform its respective index, but will be doing so at a greater expense. Generally speaking, as an investor, we should be most concerned about the fund's net return, or in other words, the fund's return after considering all expenses. Now on to the main investment categories. We'll be discussing bonds, domestic equities, international equities, and lastly, alternatives.
The purchase of stock, or equities as they're more commonly referred to, is taking an ownership position in a company. If a company that you have a stock in goes belly up, your investment in that one company is likely going to be worthless. If the company makes a profit, which is what we're all counting on, the company may distribute some or all of the profits in the form of dividends to us, or they may choose to retain the profit for growth purposes. In the latter case, we will not receive a distribution of the earnings, known as a dividend, but instead the company uses the profits to grow, so we now own a respective share of a larger company.
Bonds, rather than ownership, are loans. The most common bonds are treasury bonds, which are loans to the U.S. government. But bonds are also issued by corporations, typically to help them fund their growth.
International or foreign equities are also stocks or ownership in companies, but companies that are outside of the U.S. rather than domestic equities, which are strictly within the U.S. boundaries. You may see mutual funds or ETFs labeled as either global equities or world equities. These global or world equities are a mixture of U.S. and international investments subject to the prospectus's limitations. Alternatives are commonly equities or stocks within a specific industry or sector, but may also be more exotic, such as future contracts or stock options. As we delve into layers of subcategories, I'll encourage you all to print the asset class flowchart at the web address shown. Feel free to pause this video while doing so.
Okay, let's start with the main category of bonds. If you recall, bonds are loans. If a bank gives you a loan for 20 years, or for the entire 20-year period, you only need to pay interest, and then at the end of 20 years you paid back the borrowed amount, can they demand the borrowed amount before the 20 years is over with? Likely not, unless you have a bad contract. The same is true with bonds. When you give a loan to a bond issuer, you cannot demand your principal back, and you have to wait to the end to receive it. However, there might be another investor willing to buy that loan from you in the open market, which is how bonds are liquidated before their maturity date. So it is possible to get the loan amount back before maturity, but subject to what the market will pay for it. The total return of a bond is a combination of the interest paid by the borrowers, and also the valuation of the bond itself may create gains or losses prior to its maturity. The value fluctuations can occur because the quality of the bond may change, meaning the borrower's credit rating may be downgraded or improved, and based on the duration remaining on the loan, that could impact the value. The value can also fluctuate due to changes in interest rates. If last year you acquired a bond paying 4% interest for 20 years, and you wanted to liquidate that bond, you'd have to sell it in the market to a willing buyer. If new bond interest rates are now higher, why would any buyer take your bond off your hands when they can get a higher interest rate? The point is they wouldn't. You'd have to discount your bond to incent someone to buy it. And the inverse is true. As interest rates drop, previously issued bonds at higher rates become more valuable. When we use a mutual fund for acquiring bonds, we are relying on a manager to invest in bonds, taking both interest into account as well as likely valuation changes. We also gain liquidity as we are redeeming shares of the mutual fund, not the underlying bonds themselves.
The first subcategory of bonds is investment-grade bonds, and these are loans that are deemed to be of good quality with a high likelihood of payback, as determined by the various rating agencies. Of course, we can always debate the value of bond ratings from various agencies, such as Moody's, S&P, or Fitch, but nonetheless, in general, bonds that fall in this category are generally deemed safe from default and likely will be paid back. Investment-grade bonds can be from the U.S. government or backed by the U.S. government, or they can be loans or bonds to corporations, or for the purposes of offering mortgages. We can buy these bonds directly, but as mentioned, using mutual funds, you're hiring a manager to buy a variety of bonds on your behalf. In general, we can find bond funds that only invest in treasuries or U.S. government bonds, or only corporate bonds, or only mortgage-backed bonds, or lastly, where the manager can decide depending on the market conditions. The latter of the four is the most commonly found.
The manager may look to acquire only the safest of bonds, and therefore your yield or return may be lower, or he may focus on generating a higher rate of return while still staying within the investment grade category. And then you can expect a bit more risk to go with the hope of a bit more return. While losses in investment grade bonds is very uncommon, it can happen. For example, due to the mortgage meltdown in 2008, it was not unusual to see bond mutual funds suffer losses in that year.
Next, we have high yield bonds. In the U.S., all government-backed bonds are considered investment grade. Therefore, the high yield category can only consist of corporate or mortgage-backed bonds. These are bonds that have been downgraded for a variety of reasons by the same rating agencies and do not qualify for the investment grade label. Along with the higher risk in this category when compared to investment grade bonds is the expectations of greater overall returns. This often is the case, but of course it will vary from year to year or as the economic conditions change.
Lastly, we have international bonds. These can also be in any of the three subcategories. You may be able to find mutual funds that will distinguish between international investment grade versus international high yield, but finding that distinction is more unusual. Typically, it will be defined just as an international bond fund. It is more likely for a fund to distinguish between international government versus international corporate than to be labeled based on its underlying investment quality. The stock or equity category, which again is business ownership, gets a lot busier, but it really is not terribly complex. On the domestic or U.S. side, we break up stock investments by size And on the international side, we usually break items up by region.
Before we go further, let's explore how stock becomes publicly available for trading. We can take a Bill Gates of Microsoft as an example, and we'll assume that he decided that he'd rather have a 40% ownership interest in a billion-dollar company than a 100% ownership in a million-dollar company. Let's think through that again. Which is better, 40% of a billion or 100% of a million?
That's what I'm saying.
Yeah, exactly. But how does Bill turn his million-dollar company into a billion-dollar company? He needs funds to further his product development and to market his product. So he gets together with Wall Street type folks who put together a business plan to explain his product and concepts, and they create an IPO, or initial public offering, to try to sell a portion of his million-dollar company and create capital for his expansion. Once Bill has the capital, he uses the funds to enhance and grow the business. After the IPO, if you want to be an owner of the company, you could not buy an ownership position directly from the company. You'd actually be asking for somebody that already had shares from the initial offering or IPO to be selling them to you through the open market. So if the original buyer of the stock paid $20 per share, does that mean he'll sell it to you for $20? Well, of course not. The amount that you would have to pay and the proceeds the seller would get would be a function of supply and demand. If many people think that the company invested in will do well, that will create a lot of demand, likely more demand than supply, and that will cause the price to go up until the demand ceases at the new higher price to equalize the supply. And the flip side applies. If there are more sellers than buyers, in other words, there is more supply than demand, the stock price will go down. The obvious question is, what creates demand? Demand is created by the anticipation of earnings. If we anticipate the company's earnings will do well compared to the price that we're investing in, we'll want to participate in those earnings. Of course, if we feel earnings will fall or even cease, we'll want out as fast as we can. And that will cause an abundance of supply.
The most common breakdown of U.S. equities is done by Morningstar. This PowerPoint illustrates the Morningstar style boxes. Companies are broken down by size and defined by Morningstar as either being small, mid, or large cap. To determine which size the company is, you take the number of issued and outstanding shares of that company times the publicly traded share price. If the result is under $1 billion, it is regarded as a small company. From $1 billion to $5 billion, it is deemed mid-sized or called mid-cap, and anything over $5 billion is large cap. What is important to recognize is that U.S. companies are characterized by size, and that under various economic climates, different sized companies will perform better or worse than others. Also, since the economic climate provides varied results based on size, it is possible to achieve some diversification goals by using investments from different size pools.
On the other axis, we have value on one side, growth on the other, and core in between. If we go to the internet and Google growth versus value, the two extremes, we'll find several different definitions that reference a lot of statistical information. In attempts to simplify things, let's use Amazon as an example of a growth stock. When I checked Amazon's PE ratio this morning, it was slightly over 100. What the PE ratio means is that the P, which is the price to buy Amazon stock, is 100 times its E, or its earnings. The current price of Amazon today, when I checked, it was $236 per share. Using a PE ratio of 100 means that the net earnings of Amazon over the past year was $2.36. That's a 1% return on your money, which is what 100 PE represents today, and that might be okay on your bank deposits, which are deemed very safe and have FDIC insurance. But when we buy Amazon, we take more risk than our bank deposits, and we should expect a larger return. That's the key to a growth stock. Folks are willing to overpay for a stock today, or in other words, demand is created for that stock when there's a large anticipation that the company will experience large growth and effectively grow into its present value. You see, supply and demand in stocks is not as largely created based on what the company is currently doing as it's based on what the company is expected to do. The expectations will take into account what the company has done to date and based on all the news and gossip that fills the airways and the internet blogs. So to summarize, the layperson's definition of a growth stock is one where a high degree of growth is expected, and because of that, the price compared to the company's earnings will be relatively high. The flip side of that is a value company. A couple of good examples of presently rated value companies would be 3M or AT&T. The price to earnings ratio for 3M is 13 compared to Amazon's 100. The average large company PE right now is 20.5. A PE of 13 means the company is earning $1 for each $13 in stock price. And that equates to a 7.7% return. What would cause Amazon to trade at 100 PE or a 1% return, and 3M to trade at a 13 PE or a 7.7% return? Simply put, the buyers of Amazon, those folks that are creating demand for that stock, are looking for huge growth, while the buyers of 3M are looking more for earning stability and a good return. Of course, buyers of stock don't always get what they're looking for, and both investments represent some risk to the stockholder. But if we look back at history, we can see patterns emerge depending on the economic climate where growth stocks do better than value stocks and vice versa. Now that we've given some meaning to what a growth stock is and what a value stock is, what's large core? Well, simply put, it's a large company that falls somewhere in between large value and large growth. Again, while the price to earnings ratio is not the only factor used by many to determine growth versus value, and one can find differing definitions, it is the most widely used measure today.
That summarizes how domestic equities are classified. And let's move on to discussion of international equities. Most international stocks are divided more by region than by size. While you can find funds that specifically do international large or international small, it is much more common to see a specific part of the world listed, and the manager can go anywhere between large and small in that region. The regions are generally categorized into developed markets, which for example would include IFA, an acronym for Europe, Asia, and the Far East. Stocks in Canada, for example, would be another international developed market. Then we have emerging markets, or markets that are seeking rapid growth and industrialization. The largest countries deemed emerging markets would be, example, China or India. Other examples on the list would include Russia and the Philippines. The third international category is defined as global. The distinction here is that the investments may be anywhere in the world, inclusive of the United States, developed or emerging markets. Last of all, we have alternative investments. Usually most alternatives may be defined by their various sector or industry group. Common examples would be those on the list such as precious metals, or more distinctly, gold, healthcare, utilities, etc. Use of these alternatives can have the effect of reducing portfolio risk when properly diversified.
So why are asset classes so important, John? Well, because our economy tends to run in undeterminable cycles that tend to favor or disfavor certain asset classes. On the PowerPoint slide on the screen, you can see the Callan periodic table of returns, which can be found on the web at callan.com. This table shows a 20-year history of asset class returns ranked from highest in each year at the top through lowest at the bottom. Each color represents an asset class. If you notice the red boxes on this table, they represent large growth companies. And we can see in the later 1990s, the red box was at the top or near the top for 6 straight years.
Right.
But then came the 2000s, and that same category was 1 from the bottom in 7 straight years. Another shining example is the white boxes, which represent IFA. If you recall, IFA is an acronym for Europe, Asia, and the Far East. The white boxes certainly jump all over the board. This is a prime example of why we should be diversifying our investments.
Well, that concludes this course on defining asset classes. Now that you know more about asset classes, the keys of how to use them are very important. We are glad you joined us today, and we hope you have the opportunity to view many more educational videos from Ben Assured, including our video on diversification.
Bye for now.
Bye for now.